Hi, Mark Lund here, author of The Effective Investor. Today I want to talk a little bit about how actively managed mutual funds that achieve top performance in one period typically don't repeat their success in subsequent periods. Now take a look at the following graph. The stat graph at the left sorts the entire U.S. equity fund universe by cumulative 5-year performance relative to each fund's benchmark. Now as shown, the top quartile comprises 284 funds. The right box shows how these top quartile funds performed relative to their benchmarks in the subsequent 5-year period. The arrows indicate the movement of these top funds across quartiles. Now as you can see, only 19% of the top quartile funds repeated their top performance in the subsequent 5-year period. 42% of the funds dropped to the second, third, or bottom quartiles. More significantly, 39% of the top quartile funds did not survive the entire period. These top managers, who were perceived as the most skilled in the U.S. equity market, showed no ability as a group to repeat their top quartile performance. Indeed, almost 4 out of 10 funds did not survive, and the funds that did survive were spread across the sorted universe. Here's another example. Take a look at this next slide. This chart offers recent evidence based on 1, 3, 5, and 10-year return periods. The columns show major categories of actively managed U.S. funds and the percentage of each group outperformed by a respective Russell index. The analysis used active manager returns from the CRSP survivor-base-free U.S. mutual fund database, and the managers are grouped according to their major fund category. Although the majority of these managers in some categories outperformed in the most recent 1-year period, their success rate dropped considerably over longer periods. Overall, U.S. managers failed to match their respective index, with their failure rate climbing from 68% to over 1 year to 77.5% over 10 years. Only one fund category had fewer than half of the managers underperform over 5 years, 47% for small cap value. And no categories had a majority of managers beat their benchmark over 10 years. In fact, for the decade, active manager underperformance ranged from 58% to 92%. The lesson of these illustrations: choosing actively managed equity funds according to past success does not guarantee an equally successful investment outcome in the future. In fact, the longer the time period, the more likely they will underperform their benchmark. This is one of the reasons we do not use actively managed mutual funds in our client portfolios. Well, that's it for today. Have a great day.